yield is slightly higher. Let's go to Steve Liesman in D.C. for the details. Steve.
Federal Reserve officials at their January meeting said interest rate policy was likely to remain appropriate for a time, provided that the incoming data met the outlook. The committee saw some improvements in the global economy and a variety of other risks, but they were worried about a new risk that had really just emerged as they met at the end of January: the coronavirus. For example, some trade uncertainty had diminished. There were signs of stabilization in the global economic outlook. Participants were cautiously optimistic on trade, saying business sentiment and investment outlook were both better. They said that several judged the effect would be limited because of uncertainty, but they had a debate about that. The tariffs were still in place. The risk of a hard Brexit had receded. Overall, they said the risk of recession had fallen, but they added uncertainties remain, including those posed by the coronavirus. They said, quote, the threat of the coronavirus, in addition to its human toll, had emerged as a new risk to the global growth outlook that warranted close watching. And you've heard other Fed officials talk about this since that meeting. Now, also importantly, several Fed officials saw elevated levels of equities, corporate debt, and commercial real estate valuations. They noted the high levels of corporate debt and weak underwriting. They were also worried about bank dividend payments, reducing capital by the banks, although it was noted that bank capital levels are high. And they debated whether low interest rates created financial risks. It's a new debate. We've seen some of it on it, but maybe more in the open now. Many committee members said they, quote, should not rule out the possibility of adjusting the stance of monetary policy to mitigate financial stability risks. Finally, they saw the labor market as strong. Pardon me. And, a few thought that you could let the job market run further, saying the current employment levels is below possibly the maximum employment level, though there was also concern about running tight labor markets and financial imbalances. So they were looking at a better and brighter outlook, but then the coronavirus came along as a new risk that they're now watching, and I think those both the data, as Greg Ip was saying in the last segment there, and their thinking has moved along since the end of January when this first appeared. Tyler?
Yeah, so it's very interesting. This is the end of January. I'm waiting for the day, Steve, when they say current policy is inappropriate. But I'm just going to wait a long time for that, I know. You talked about how there is some discussion of whether low interest rates might create financial risk. What are they driving at there? And are they driving at the idea that when you get low interest rates, you have the possibility of inflating other asset categories, whether it's bonds or stocks or whatever? Is that what they're driving at?
You're exactly right, Tyler. There is some concern on the committee that you run accommodative policies for quite so long and that you create financial imbalances. Look, they see the stock market going up every day just like we do. And there may be situations, it says here, the staff, when this persistently accommodative policy could lead to financial stability, financial system vulnerability. So the staff is warning about this. There's also a quote in the minutes, Tyler, where they discuss this idea of some think that some market participants believe that what's happening on the balance sheet side, in other words, increasing the balance sheet, leading to higher equity prices. So Fed officials are, I mean, I don't know a better way to say this, they're aware of the debate that's going on every day on CNBC about the impact of Fed policy on what's happening in the markets.
One more
today.
quick one, if you don't mind. Does your reading of these minutes cause you to agree more or disagree with what Greg Ip just said? And that is, namely, that if there is any bias in the thinking of the Fed, it is probably a bias toward lower rates later in the year.
I think that's right. I think they want to see the risks out there clear. There's a debate about whether or not what happened with trade at the end of the year is really going to lead to increased business sentiment, increased business investment. If that were to happen, they could change their opinion right now. But because of this coronavirus, because of other things that are out there, Tyler, I think that bias is towards cutting. Although right now they're saying very clearly, as you said, policy is appropriate.
All right, Steve, we appreciate it. As always, Steve Lee.